Hello, everyone, and welcome back to The Road to Financial Freedom, a podcast that allows experts to share their stories and secrets to unlocking their financial independence. This podcast is brought to you by CamaPlan, a self-directed IRA administrator in Ambler, Pennsylvania, that is focused on educating investors with different ways to grow their retirement savings faster through alternative investments. And once again, we are continuing to record our podcast episodes remotely. I'm Jess Jones, CamaPlan team member and podcast host. This week, we'll explore another stop along this path that many of us encounter. So maybe you've decided to start taking control of your financial future by opening a self-directed IRA. That's great, but even after you've opened and funded the account, done your research on alternative investments, and found that perfect first deal to get yourself started, the next challenge still remains. How do you make sure you have all you need to complete that perfect deal? If your IRA lacks the funds to make a purchase, how can you ensure that you don't miss out on the investment opportunity while still staying within the IRS guidelines? As one of CamaPlan's longest standing team members and salesmen, Ryan Fischer has helped many new and existing clients navigate the ins and outs of funding their deals. He speaks all over and joins us today to discuss creative, effective ways that you can fund a deal in your IRA, which includes ways such as co-investing, borrowing, lending, and other strategies. So thanks for being here today, Ryan.
Thanks. Glad to be here with you today, Jess. I do want to start and say CamaPlan does not give any investment advice or endorse anybody. All the information here today is for educational purposes. We encourage people to work with their professionals, CPAs, attorneys, etc. So great. Glad to be here.
Great. So thanks again, Ryan. How have you been, by the way? I know we haven't seen each other in quite some time. We used to be a couple desks away. Now we're so far away.
Everything's been great. How about yourself?
Pretty good. Can't complain. You know, we're going on month, who knows at this point, but things are moving and shaking. So we still have a number of people that are here opening accounts and starting to fund their deals. So that's what we're here to talk about today. Let's start out pretty basically. What are some of the more traditional ways you've seen folks fund their IRA deals?
Sure. And we do have 20 ways to fund a deal on our website. I know we won't be able to touch on every single one today, but we'll go through a few of those. Obviously, one of the most common ones is somebody's IRA has enough funds, and we'll use real estate for these examples. But they can purchase the full property price with what's in their IRA. That's pretty straightforward. But then you get into other spots where people say, well, my IRA doesn't have enough money. What are my options? There's a few different ones there. You can partner it with another IRA, even your own IRA. I've seen people take their Roth IRA and their traditional IRA at X%, but I'll just use 50-50. It doesn't have to be 50-50, but so the purchaser of their property would be CamaPlan, FBO, John Doe's Roth IRA 50% and CamaPlan, FBO, John Doe's traditional IRA 50%. Now, in any case at X%, when you split those, each account is responsible for its percent. So in this case, the Roth, if you needed to do a repair, would pay 50%. The traditional would pay 50%. Any profits that come back in, such as rental income or sale, would be split 50-50 with those accounts.
Oh, okay. And so, Ryan, just to clarify a bit more for myself then, so what you're saying is if you were to co-invest with, your traditional IRA and your Roth IRA, and does this go for, say, like you're co-investing with a friend's Roth IRA, and that percentage is broken down 50-50 or 75-25, something like that. No matter what the breakdown is, everything is kind of broken down that same way. So any interest that comes into the accounts from the investment or any payments that come out of the account?
Correct. Yes. They'll be split at that percent. And that is a good point to bring up. Yes, it doesn't need to be your own IRA. It could be somebody else's IRA. It doesn't even have to be an IRA. You could, and this is actually also, I'm going to step back here just to make this clear, because a lot of people get confused with disqualified people. Obviously, you're a disqualified person, right? You can't lend your IRA money. You can't have your IRA buy a house and live in it. However, partnering is different. So we're just going to I'll use myself as an example again here. Let's say the purchaser of the properties, CamaPlan, FBO, Jess's IRA, we'll use you instead. Okay. And let's say you're going to use your own personal money. Now, people that again, partnering is different. You got to look at the IRA as its own entity, right?
Right.
So you could buy it 50% Jess's IRA and 50% or whatever X percent Jess personally. Or maybe your mom wanted to be in the deal with you, or your dad or your brother. You can do that. I've seen other people, husband, wife, and two of their kids are part of, the purchase of a property. So it's obviously able to be done. It's just each entity would be investing X percent into the deal.
Got it. So then my IRA is a separate entity. So when it comes to engaging in a prohibited transaction, that would occur if I say with the percentage that my IRA is invested in. So let's say I buy a house 50% with my own personal funds, 50% with my IRA funds. But if I go in and engage in something and use IRA funds to do so, and where does the line get drawn basically then? Where does it become disqualified versus, this is the percentage that I'm involved in. So I am I think I'm just a little lost still on that in terms of, okay, well, where does the gray area get less gray and become a little bit more black and white?
Sure. Well, great point, but all the rules stay the same. Just because you are 50% doesn't mean you get to use the house 50% of the time, do 50% of the work or anything. If an IRA is involved, all the same disqualified, transactions and everything are still there. It doesn't matter, if the IRA is 1%, well, everything still applies there. So you couldn't go live in that house. You couldn't do the work on that house. You still are looking at it as an investment, and all the rules apply no matter what.
Got it. So I can use my personal funds to help fund the deal. I just can't do the same things that would be considered prohibited, such as I can't do the work on it. I can't go and live in the house. I can't.
Right.
And the same goes for any lineal ascent or descent, family members of any lineal ascent or descent. So my mom couldn't do that, even though her IRA funds or her funds are partnered with my IRA's investment, right?
Right. Yep.
Got it. Okay. So that makes sense. It kind of clears things up, at least for me. I think it's going to help clear up for a lot of our listeners too, the idea of where that line gets drawn. And when they hear, oh, well, I'll co-invest with my money, I thought I couldn't be involved in that. I think that'll help clear things up for people, probably help them understand that, hey, I can make that deal then if I can do it that way. So thanks, Ryan.
Sure.
And then, so there's the idea of being able to co-invest with businesses in addition to people, or small businesses or things like that. So are there any differences that come into play if you're co-investing with a business versus a person or their IRA?
No, it's the same, just like if you did it with yourself. But again, to make that clear with people in prohibited transactions, like you couldn't take your IRA and lend your LLC, for example, the money and then have your LLC go buy real estate, because your LLC, you own it. Let's say you own it 100%. Well, then it's going to be a prohibited entity. But just like you partnered with yourself or somebody else, right? Your IRA can now partner, with your LLC, right? Your LLC buys it X percent and your IRA buys it X percent. Again, everything will get split and everything will stay like that. It's just split however you do that right from the beginning.
Great. So that covers co-investing pretty well. Do you have any examples of, I know borrowing is another way that people can ensure that they can fund a deal. So do you have any examples or some more information on what people can do in order to borrow in order to fund their deal?
Sure. The answer is a non-recourse loan. A lot of people will kind of confuse that and think of the traditional way. Hey, I'm going to go buy a house and I'm going to get a mortgage. Well, mortgage is the wrong term to use there, because you're not getting a mortgage. The IRS says, it's still very, very similar, but basically a non-recourse loan. Like, you can't personally guarantee anything back to you being a prohibited person. So the non-recourse loan basically says if the IRA fails to pay the lender back, the lender gets the property. Okay, well, that's pretty common. People do that in real estate anyway. But similar to a mortgage, well, if you don't pay the bank back, they're going to foreclose on you and take the property too. But they can't take anything else, right? So if you do that, with a bank, they can come after you personally and take other belongings. The IRA, again, is its own entity. You can't personally guarantee anything for it. So that's why it's going to say, if it doesn't pay it back, the lender's going to take the property. there is no recourse against you. They can't come take your personal house, your boat, etc., like that. All they're entitled to do is take that property. Now, you will see when you get those non-recourse loans, and they're common, they're out there. You can get them from institutions, you can get them from somebody else, you can get it from somebody else's IRA even. That's pretty common with private lending. But I wouldn't expect to walk into a big bank because they're not in the business of really doing that. I don't want to speak for anybody. I have seen some do it depending on the relationships they have with people. But if anybody wants more details there, we have some institutions that do this. But like I said, if your best friend wanted to lend your IRA money, or you had another investor that you worked well with, they could lend it out of their IRA, they could lend it out of their pocket, whatever they wanted, as a non-recourse loan to your IRA. And obviously, you would make those terms up of how long you're lending, what interest rate you're lending it at. That's up to those parties involved.
Great. I think that's reassuring for people, especially just because, things happen. And for those things to happen in a deal from your IRA, which is a separate entity from you, I think that's probably reassuring for a lot of people to hear.
And I just add one more thing onto that.
Sure.
I do want to say, and again, don't quote me on that because I don't want to speak for anybody, and all this is done on a case-to-case basis.
Exactly.
But plan on having 40 or 50% of skin in the game if you're getting a non-recourse loan. I'm not saying it's 100% that that's going to happen because I don't know who you're working with, but it's not necessarily going to be a 20/80 like you might get from a bank.
Right. And that kind of leads into my follow-up question that I did have based on your explanation of non-recourse loans, Ryan, is in terms of reporting, is there anything that people have to make note of if they're taking out a non-recourse loan? Do they have to report that anywhere on their taxes or on their 1099s or anything like that?
There is, but that's the form they would use is Form 990T, 990T. And that form is used for two cases: UBIT, which is unrelated business income tax, and UDFI, which is unrelated debt financing income. So the UDFI, the non-recourse loan, would fall under that. So yes, and basically that form is for the IRA to pay taxes because it's going to pay some taxes on the borrowed money. But that's somebody's accountant and stuff can, help them with. There's an equation, that they'll do. It's not that difficult, but now also, they can get depreciation because they're paying some taxes and things. But we won't get into that because that's more for their accountant. But yes, they need to be aware that if they have a situation where UDFI or UBIT or UDFI applies, then they would be responsible to work with their accountant to file that.
Great. Awesome. Well, thanks for sharing. So similarly to my other question about, does it differ if you're co-investing with a business versus a person? Is there a difference if you're securing a loan from a hard money lender versus a non-recourse loan? Is there a difference in hard money lending that differs from a non-recourse loan, or are they similar?
No, they're similar. The main difference is going to be that, even if it's hard money, it still needs to be non-recourse if you're talking in the same kind of realm here. But obviously, hard money is probably going to be more expensive. Traditionally, like with the institutions I've seen our clients use, typically they're, maybe 2% more than what the going rate is at the banks. Again, that can change. I haven't even looked at it in a while. It's not usually as bad as a hard money loan. It should be cheaper than that from what I've seen out there.
Great. Alrighty. So another way that people fund their deals that gets covered in 20 Ways to Fund a Deal is lending money or being the bank. So can you talk a little bit more on that and the ways that people can do that?
Yeah. Private lending is pretty big out there. This all depends on somebody's expertise and where they are in life and how much time they have. We do a lot of real estate, but a lot of our private lending's done on real estate, right? So basically, you can take your IRA and make it a mini bank and lend money out. So let's take, for example, someone like a doctor, right? Well, they have to be in the office and see patients. They might love real estate, but we can all agree that real estate is work. Mm-hmm. They may not have the time to do that, but they'd love to take some of their portfolio and lend it because they understand that, okay, well, I'm going to lend you X dollars secured to 123 Ocean Ave. And if you don't pay me, then I get the house. Okay, great. That's, fine. or everything goes as planned and I make X percent, whatever I'm happy with, whatever the deal was that was cut. So that really depends on the person, but it's very popular. There's a lot of, when I say companies or builders, there's tons of people always looking for money. So it's very easy to get your money deployed. As long as you're working with good people, obviously do your due diligence, because I've seen people do unsecured lending as well as secured, which basically the difference is unsecured, you don't have anything to go after, and secured, you're saying, okay, well, if you don't pay me, I'm going to take the property. So you definitely want to do that and work with good people. So I encourage you to do your due diligence.
Is non-recourse considered unsecured or secured, Ryan? Does that tie into it at all? Are the two versions of being able to fund a deal, borrowing or lending, related in that a non-recourse loan would be considered something that could be unsecured or secured?
The non-recourse is secured. Like I was saying before, basically, right. If your IRA fails to pay, the lender back, the lender's going to take the property. So it would be secured to the property.
Got it. Okay. So I think when I hear non-recourse, I just hear like non, and I think like, oh, something could be potentially unsecured, non and un. But I think that makes way more sense the way you're describing it. So thank you for clarifying. So in the case of being the bank or things in that, what are some of the terms that need to be negotiated to make sure that, a loan is paid off properly, or you're getting your payments from your lenders or things like that? What are some of the major terms that people need to be aware of or do their research on if they're deciding, okay, well, I'm going to lend money out?
Well, basically, again, that's up to them. A lot of people choose to be paid monthly. Some people say, okay, well, I'm going to lend it to you. And once, let's just say somebody might be flipping a property. Your IRA lends them the money, they go buy the property and they flip it. Well, they might not, they may have agreed to say, okay, well, once you've done that and you sell the property and the profits come in, go ahead and give me, my money back plus my profits. So that's really a personal preference. And obviously that also depends on, the current deal that somebody's working with. So
cool. Well, so there are some other strategies to fund deals that are not under these three kind of umbrella categories that we break it down in our 20 ways to fund a deal. It's wholesaling a contract, joining an entity, and investing in a fund that buys real estate private REIT. Could you kind of break down each of those three, what they do, and some examples of how each of them work for us?
Sure. We'll start with investing into a fund. A fund is pretty straightforward. Most of the times you're going to be buying X shares or X units, depending on how the contract's written up. So someone could be buying a multifamily, or let's say they're buying a $10 million apartment complex. Well, they're going to go, raise money on that. Maybe you're putting in $150,000. So whatever that equates to in their shares, you would get $150,000 of there. So you're just part of a bigger deal, but you're just investing into the fund, and that'll be defined as to, what your return and everything is on that when you do it. So you don't have to have the $10 million to be part of a $10 million deal. So a lot of people like that, and they like the security of, having a big property like that.
Got it. So you don't necessarily have to be something that's come up a lot on this podcast is the idea of an accredited investor, where you need to have or make a certain amount of income in a year, things like that. With some of these, in some of these funds, do you have to be an accredited investor, or is it kind of like you've said before, sort of on a case-to-case basis? There are funds where you don't necessarily have to be accredited to join?
Both. A lot of the funds are accredited investors, and most of the time those are, they abbreviate it and say Reg D and Reg A, but Regulation D funds that usually an attorney will set up, and it does define that you have to be an accredited investor. However, there are other ones that people have chosen to set up, Regulation A funds, I believe, you do not have to be accredited with. So it just depends on who you're working with. But yeah, to be an accredited investor, you need to have $1 million in assets, excluding your primary house, or make $250,000 2 years consecutively to be considered an accredited investor.
Cool. Thanks for clarifying. So what about wholesaling a contract or joining an entity? I guess we'll go back to joining an entity. Is that similar to investing in a fund, or how do they differ?
It is. It's pretty similar, but again, most of the time people can do what they want to do.
Right.
You just got to look at how you want to structure it. You could be partnering with somebody's, LLC, like we were saying before, or some other entity. Sometimes people have done it, with a trust, right? So you just got to, like, everything is, like you're your own entity with your social security number. Your IRA is its own entity, and it's going to get its own tax ID number as well. An LLC or another entity is going to do the same and get a tax ID as well. The difference is, the IRAs are going to be treated differently, either tax deferred or tax free, depending on the type of account that you have. But basically, yeah, you can co-invest with, other entities, and that's, not a big deal.
Cool. And how about wholesaling a contract? How does that differ from everything?
Well, basically, wholesaling is really just, well, to clarify that for our listeners then. So a wholesale, you're not actually purchasing the property. You're agreeing to purchase the property. Let's just say that you're going to go buy a property for $200,000, right? Or your IRA was. So your IRA says, okay, I'm going to go put, $1,000 down on the house, and I'm agreeing to pay $200,000 for it. Well, with your due diligence and what you've looked at, you'll say, well, the house is worth, in the condition it's in, or maybe you do something. Well, let's just say you're not doing anything to it. It's worth, somebody would pay, or I have an investor that'll pay me $215,000 for it because I found the deal and I got it. So now I can turn around and sell that to the investor for $215,000, and my IRA just made $15,000 because I agreed to buy it for $200,000, right? Well, they come in, and the title company or attorney, depending on what state and stuff you're in, will close on it. And I never even had to put the $200,000 out because $215,000 was coming from whoever was going to buy the property. They call it double closings and some different things like that. But basically, for $1,000 I put out, I made 15.
Cool. Thanks because I know even for me, I hear wholesaling and I didn't totally understand exactly how that works. So thanks for putting the word into action. I think that it'll help a lot of people listening to kind of understand what that is and what it means when they see it.
Now, you do have to be careful if you're doing that. If you're doing that in the IRA, because, well, we won't go into that, but you most likely will have UBIT if you're doing a bunch of wholesale deals. So you do want to pay attention to that if that's
right.
your goal.
So that does lead me to actually one of my major overarching questions with all of these deals and ways to fund a deal in mind is if you can touch on what some of the benefits of funding a deal through these strategies are, if you've seen success stories, or if you've seen on the opposite end of things, anything that, investors might want to avoid or things they should be aware of just based on some stories where the situation was not as successful. Just what are some of the benefits and what are some of the things to watch out for when it comes to creatively funding your deal in this way?
Yeah, well, again, it really comes back to the deal. I like to think we have a lot of educational material out there and on our website. And I like to think that our investors are at kind of a higher level of investing. That's why they're looking at this. And it's easy I don't want to say easy, that's relative to the person, but buying stocks and mutual funds, Wall Street stuff is really just pretty simple. You're doing it virtually on a screen. But these alternative investments are a little bit more difficult, I would say. Obviously, you got to find a fund or a piece of property, that you think will perform for you, right? So it's going to come down. Now, you could make a bad decision, right, and buy a property, and then the next thing you know, you didn't know it needed a roof and the septic tank's leaking and all this stuff. So you could lose money, and that's why it's very important that everybody does their due diligence. But then back to the whole thing that this is a property that, is an investment. Most people overpay for themselves personally, but for the investment, they're looking for a deal, positive cash flow, a way to make money there. So generally speaking, I've seen it, our clients do very well. And I have also seen people that have had a relation. That's why I say, you got to work with good people, because
Right.
I kind of say, well, everybody's your best friend until they don't pay you back. And I've seen that before. Oh, I've known them for 20 years. We do all these deals together. Okay, well, if something goes south and you don't get paid back, yeah, you can lose money. It's just like, if you buy a bad stock and they go out of business, and you would lose your money, right? So
Right.
there's risk in everything that we do. The goal is just to mitigate that risk.
Right. That's a good idea. That's a good way of putting it. I think that it helps people understand, especially the whole stock example of like, okay, well, if you invest in something that's quote unquote more traditional, you also run a risk there too. So it's not like alternative investing is that much. I mean, obviously there is a certain risk evaluation that you have to evaluate for yourself and for your investments, but it's not like you are running a no risk game if you're investing in traditional assets.
No, there's always risk. The thing is, we get with the alternative investing, we get more control over it. We know, I'm just going to say somebody's done their due diligence and it's their neighborhood and they've lived there and they know what the house is rent for, et cetera, that kind of stuff. And you also know that it's not going down to zero, but Detroit came close at one point, right? But you know the asset, and you say, okay, well, I'm buying this property for X dollars. It's going to rent for X dollars. If the economy does a little worse, maybe it makes $100 less. If it does a little better, maybe it makes $100. There's just a range there, so you can kind of do that, and you know that people need a roof over their head, for example, right? So it's going to have a value to it. We can't control, what happens with oil around the world or other companies. We have no control of that. It just goes up and down. I mean, the house may go up and down, but guess what? That rental income is still coming in at the same price. Because people asked me that back in 08 and 09 when the stuff went down. Well, technically, a lot of people were upside down in their houses, and the rental market did well for people that were holding properties there, because people said, well, I got to get out of my house. It's not worth it. And now they're renting other people's properties. It didn't matter that your house was worth $400,000, and now they're saying it's worth $300,000 or $200,000 for that matter. Let's cut it in half. Guess what? The rental income didn't change. That person's still living in that house, paying the same rent. It doesn't matter that the value of the house went down. So you just gain more control to a certain extent. Wall Street, we really don't have a lot of control over at all.
Exactly. Yeah. And I think for a lot of people now, I think control is such a good word for something a lot of people feel like they need more of now, especially with the amount of control we don't have in even our daily lives in terms of Corona and being, stuck in quarantine, and there's no sign of a future for some things, but there's ways that you can actively try to work at gaining control. And I think that it's a good word to use, especially in the example of ways that you can start to make money for yourself, earn more of what you, or keep more of what you earn, So I think that's great, Ryan. I have a couple of other follow-up questions just now that we've touched on pretty much everything from the 20 ways to fund a deal in terms of information, just more questions about that have come up just as you were talking. So I'm starting out in terms of investing. I'm, just about to buy my first car. I'm doing all these things. And I'm just thinking to myself, if I wanted to start investing in a self-directed IRA and I wanted to buy a house, I'm nowhere near close to being able to do that with IRA funds. Even if I did maxed out my contributions, things like that, opened up a Roth and a traditional, I'd still be stuck. So I guess one question I have is, what do you think in terms of newer investors or younger investors, people who come to you, and I'm sure you've had a lot of people come to you in events where you've spoken at or things like that, who are around my age or just starting out, something like that, who have questions about, what's the best thing for me to do? And I know we don't give any advice or anything like that, but what are some things you've seen newer investors do in terms of structuring deals creatively?
Well, there's a few different things. Like you said, certain accounts have, all accounts have contribution limits, but some of them are higher there. I think it's definitely something people should enlighten themselves to kind of like take a look at. You're right. So if you open up your Roth IRA and you put your $6,000 or $7,000 in, depending on your age, where you're like, okay, well, now what am I going to do with that? I mean, I think everybody should have a Roth. I'm partial to them, tax-free, for the rest of your life on all your earnings, I think is great. I would still encourage them, if you're putting it in a savings account, then go ahead and put it in the Roth IRA. You can take out your contributions anytime you want with no taxes or penalties. But I would start putting that in every year because, while 6,000, like you could go put $6,000 in today, and then come January, you could put another $6,000 in. So now you have 12,000. Well, maybe somebody that, needs to redo their bathroom or something, and you can lend them the money, right? You can be a lender to a project. Now, obviously, you'd have to have your network of people to do that, because somebody might say, well, I don't mess around with $12,000. I need $180,000. So that'll just depend on people's network, but you can also partner them into deals. Like I said, too, you talked about wholesaling. We could do that. Again, the IRA may end up paying some taxes, but that's okay. But it could go get a jump start on something like that if you did do a wholesale deal, for example, right?
Right.
So it's really going to depend on the person and what they are looking to do and what they have the capability of doing.
That's a good way of putting it. I think just knowing myself, I'm, as you know, coming from a theater English background, math has always been something I've been averse to. I have, up until now, I think I've broken those self-deprecating thoughts about myself in terms of, I don't know how to handle my money, and I don't know how to spend my money, things like that. But even for myself, I still would probably want more of a hands-off approach. So when you've mentioned it before, like real estate does require inherently a bit more work. So it's not something that I know I would technically want to be hands-on with just yet in my life. But that's not to say that can't change later when I get older. So I think that's a good way of putting it. It's just like giving yourself time and knowing what you want, what you're capable of, and letting time run its course too.
Yeah, I mean, there's a few other things. We didn't touch much on this. We did with private lending a little bit. But there's also, when I say notes, there's obviously new notes like private lending. And then there's existing notes, and there's companies that you can buy them from as well. And that includes first and seconds even. So you could, if you were just starting out, take, for example, that example I just gave you. You put your 6 in now, and in January you put your 6 in. You may be able to go get a note, for $12,000, or you build it up, and then when it has 20 or 30, you go buy a note. But you have to start trying to get the money in now. Otherwise, it'll always be, a small amount. But for people that own their own businesses, they can set up solo 401ks, assuming they don't have employees. But they can also set up SEP IRAs and simple IRAs. For example, the SEP, you can put $57,000 in. So there's ways to jumpstart it depending on, where you are and what you're looking to do. There are ways to get more money into different types of accounts. And then you can roll that money, from qualified plans in as well. So, but you may have to start out, with, an account at a bank or a brokerage house till it builds up enough money, that you can do something in the alternative space, because it's just going to depend on what you're trying to do.
Yeah, I think that's a good way of putting it, and, trusting the process, but also doing the work and getting yourself ahead while you can. And I think you touch on it, starting out as early as you can is a great move.
Absolutely.
Yeah, definitely. And so you touch on one of my other questions in the response you just gave, but I was just also wondering, in terms of these ways to fund a deal and all the different types of accounts that can be self-directed, and what those accounts are capable of doing, or what those earnings are used for. Does it matter in terms of what kind of account you have and what kind of deal you're doing? Like, I know we talked in the very beginning, if I'm co-investing my Roth, does it differ in terms of if I'm co-investing a Roth and a health savings account? Does it just mean whatever gets earned from that deal that I've co-invested in, I can only use the health savings account portion for health-related qualified health expenses?
Well, the accounts, again, will be their own entity. Unlike IRAs, health savings accounts don't. So the IRAs, to take money out with no penalty, you have to be 59 and a half. Health savings accounts, let's say you did a deal with it and you needed money for surgery. Well, you can take money out of your health savings account anytime, any age for any qualified medical expenses. I even think, your, reading glasses or whatever are covered under that. That's a pretty big list. But yes, you'd be able to take the money out of a health savings account for any qualified medical expenses.
Cool. I think that's cool to know. Thanks for clarifying that for me. The only other question that comes up for me, and maybe this will spark some more questions too, is it's a simple one, but it also can be, I think you can go into probably some more detail on it. In terms of co-investing or borrowing, lending, but any of these things, can it be broken down? I know we've talked 50-50, 75-25. Can it be broken down into further entities? So let's say you, me, and another friend go in on a deal, and we use, all three of us use our IRAs to do so. And then I pull in my mom's IRA, this and that. Can it be, what is there a limit on how many IRAs can help fund a deal, or how many people's funds can help fund a deal?
No, there's not necessarily a limit, but then it becomes down to accounting and paper. Well, actually, I'm going to step back there and say there could be a limit. That's more of an attorney question, because I do want to say if you're pooling a bunch of money that there is a limit, and I don't know those limits. So, for example, like I go back to the apartment complex, private placements, which a lot of people are familiar with, PPMs. So they might be getting 100 investors, investing into that. So then it does become, the attorney has to set it up and file a PPM. So yeah, there probably is. I don't know the number, but like I said, I've seen multiple people do it. I mean, most of the time somebody's not going to have more than a couple entities just because it gets complicated. Like I said, I've seen people do it with, their spouse and their kids and things. But if you're going to start pooling other people's money, I think there are some provisions there, but that's for the accountants, attorney, and other professionals to kind of.
Got it. I was just thinking of that family on a TLC, that 19 kids and counting, and if they were to do a deal and all work together, how that breakdown would work. So I don't know why that popped into my head, but I was just like, what if an entire very large family decided to fund a deal all together? How would that work? So I think that helps. And I definitely agree, consulting your team of financial professionals would probably be best if you're going to be that adventurous and rope your whole family in it. But
there are ways people have done that. I'll just touch base on that, because obviously if you did it as the IRA with every 19 separate IRAs, for you and the kids, then splitting everything 5% here, 17% here, because they're all going to depend on their age, depending on when you put it in or whatnot. It would be difficult to kind of keep track of all of that. But in that case, when people have done similar deals like that, they'll create an LLC that each IRA owns X percent of. So then all the money just goes in and out of an LLC, for example. And then at some point when you're going to pay the IRAs back, okay, well, the one IRA is 60%, the one's 30%, the other one's 10%, the other one's 7%, whatever. That doesn't add up to 100, but you get my point. That it would just be part of, whatever percentage of it was of like the LLC, for example, if you use that to create it. So that's how people usually handle if you're going to put multiple ones in like that. Generally speaking, people don't have 19 entities in there. If they're doing something, like the apartment complex, they're going to create a PPM, and that's how it's going to be done.
Cool. Good to know. Well, thank you. Is there anything else that, has come up in this conversation, or any questions you think I haven't asked that have come up in some frequently asked questions you've heard from a lot of prospective clients or current clients that you want to touch on before we start to wrap things up?
No, I think your questions were great today. And if anybody or any of the listeners do have questions, how would you like them to reach us, Jess?
Sure. Well, I mean, the best way for you to reach CamaPlan would be to head to our website, camaplan.com, or you can also reach, Ryan can provide his personal, email, things like that for you to get in touch with him directly if you have specific questions for him. But you can also reach us if any general questions at info at camaplan.com, or you can give us a phone call at 215-283-2868. We also have a toll-free number that you can use as well that's also found on our website. So you can check us out there. You can check us out on social media. I think it's all just CamaPlan. If you looked us up, you'd be able to find it pretty easily. That's CamaPlan. And Ryan, how can people reach you if they have any specific questions?
Sure. It's just going to be R Fischer at CamaPlan, and that's RFISCHER at CamaPlan.com.
Great. Well, thank you, Ryan. Thanks for joining us today. I think you offer a lot of great insight. And providing a lot of great detail, examples, and some candor when it comes to breaking these deals down and things you should be aware of, things you should look out for, and also the ways that breaking down your deals this way can benefit you and can be done in your IRA, even if things feel discouraging. You don't have the funds right away. There are ways that you can definitely make your deal happen, get that deal done, and get it in your IRA so you can start making your money work harder for you in the future. So
Absolutely.
Again, appreciate it.
Thanks for having me.
Good. Well, thank you again, Ryan. Appreciate it. If you do have any questions for Ryan or for our team at CamaPlan, please feel free to reach out for us. Tune in next week to hear more from our experts who've paved their roads to financial freedom, or you can call CamaPlan today to learn more about how you can start to take control of your future wealth. Thank you, everyone.